Welcome to The Interest. I'm Christine Stewart. This week, Bill Bodnar gives us a peek at what's happening with the economy and master the markets. And our own Vincent Valvo and Andrew Berman put back on the gloves to battle it out in another cage match. But first, we take a look at some of the changes that were made this year by Fannie Mae. The GSE launched its modernization and touted the updates as a way to help lenders, appraisers, and risk investors achieve higher accuracy, lower cost, and faster loan decisions for consumers. But valuations can be tricky. We talked to experts about exactly what the improvements mean for originators and borrowers. Let's take a look.
In terms of how it's affected us, I just think it's a part of our daily culture. It's a part of our ethos, really, to make sure that we're, keeping up and staying on the forefront of where the industry is headed, and trying to be thoughtful and helpful in helping the industry meet its goals for those things.
Sean Pyle, president of Value Trust Solutions, says it's ultimately up to lenders to guide the valuation process for each individual loan application.
Understanding where the benefit can come from a consumer experience and trying to marry that with possible improvements within their own operations can be something that I think will ultimately lead to success in this process. And
with any new initiative, there will be risks. Technology can be a benefit, but it can also be harmful.
I think that role is important. And I think, all of us that participate in the valuation space within our industry have to be mindful to try to keep, advancing as technology and information allows us to advance, with safeguards and guardrails in place to ensure that we're not introducing undue risk into our industry.
To read more about the GSE's modernization effort, go to mortgagebankermag.com. For The Interest, I'm Christine Stewart.
Angel AI is revolutionizing the home financing process. Here to tell us about it is Pavan Agarwal, the CEO of Celigence, the company behind this new amazing app. Tell us how Angel AI is helping the home financing process.
We use empathetic AI technology, so Angel AI understands the emotions behind human inputs so that the application to approval to close of a mortgage is nearly free of human touch and free of human error, and is lightning fast compared to the manual standards of the real estate industry today.
What about the people who have found it hard to get a mortgage?
Angel AI has made the approval process for mortgages fair and transparent, such that we have cut the decline rates for minority communities by half relative to the national average. Just go to angelai.com or click the Ask Angel AI Now button and ask Angel AI your home finance questions, or simply ask her to send you one of these cool free t-shirts. Angel AI has transferred the home financing business and made it fairer and easier for everyone.
Hello, everybody. Thanks for tuning in to our Master the Market segment. First off, happy Thanksgiving. We hope you and yours have a wonderful holiday. So last week was something, right? We had watched interest rates decline to the lowest levels in a couple of months. Why? Well, there was a lot of bond-friendly data, specifically in the inflation front. Every reading for the week, but the big one was consumer prices. Consumer prices fell across the board, month over month, year over year, headline in the core. So that was a really nice thing to see. And so what's interesting is in normal times, interest rates move lower when inflation goes down, economic activity slows down, and unemployment rate moves higher. That's exactly what we're seeing right now. But what we have to ask ourselves over the weeks and months ahead, are these normal times where we still have a bunch of people betting on higher rates, hedge funds, and shorting the market, which is adding to the volatility. But we also have an unprecedented amount of debt. We have deficit spending where every couple of weeks we have to sell a bunch of bonds. And this week we have to sell some. And it will be interesting to see if the decline in rates that we've seen, is that interest rate enough to entice buyers to buy, or does the Treasury have to issue maybe a higher yield to get people to buy the paper? So that's what we have to deal with. And then on Wednesday, we do have the minutes from the last Fed meeting. The good news is, in all of this, the Fed looks like they're finally done. That inflation reading last week, I think, just put a complete pause, and the next motion from the Fed might actually be a rate cut. So listen, I hope this finds you well. Have a terrific Thanksgiving, a great week, and we'll talk to you soon. Bye for now.
Okay, so Vince, do you think mortgage brokers can survive if rates continue to climb?
Well, it depends on how far they're going to climb. I mean, right now we're already at the 8s. They're surviving. They're having a hard time surviving. Listen, we get to 9, we get to 10%. I don't think it's going to be very easy for these guys to survive.
Interesting. Well, so here's the thing. I think actually that our industry is right now going through a transformation. We are going to see IMBs and of course banks, depository banks, losing control of mortgage transactions. And these are going to go to mortgage brokers. Mortgage brokers are able to deliver a better rate in many cases. Same technologies that the biggest banks are delivering, so they can compete even in a higher rate environment.
Yeah. Okay. Well, I agree with you on that. Okay, because I want to reframe the conversation here. Yeah, I know. I finally agree with you.
Can we end this now?
If you were asking me, if you frame this as a different way, if you had framed this in saying, can mortgage brokerages as a segment survive with higher rates? I would say, well, absolutely, that's true.
That's what I said, mortgage brokers.
You said mortgage brokers individually. Now, my problem here with brokers and LOs, can they survive when the rates get up there? I think that's going to be a lot harder for individuals. You'll have brokerages survive, you're right, because I think that they are more flexible. They've got more opportunities to present consumers who are coming in for mortgages. I just think the real problem is you've got this constricted inventory like this, right? This is all, we used to have an inventory bucket that was this big around, and now we got this little thing of stuff that we're trying to sell.
But
when rates go up, it's going to get even smaller.
Of a smaller pie.
Yes. Brokerages, I think, are true. But I do think that what's going to happen is you're going to see even employment at those brokerages is going to have to fall, because you can't keep this many people out there scrounging for 1 or 2 deals a year, much less 1 or 2 deals a month.
You call brokerages, most brokerages are small mortgage companies that are basically mortgage brokers.
Yeah.
So they are synonymous there. They are pretty much the same thing. And if you think about a lot of originators who work for even like the big brokers, they're operating as a brokerage, because they're in many cases they have actually their own tech stack. They have a lot of their own expenses that they're paying for anyway. So, but they're getting the same technology that the big IMBs are having difficulty. They're asking for handouts right now.
I'm not fighting with you on that. What I'm saying is that I think individuals, I'm thinking that individuals are going to have an issue, but I think that brokerages as a component, as a segment, are probably going to actually pick up market share. So, Andrew, it pains me. It's like my heart is breaking over here, because I have to admit that this one I've got to give to you. You won.
For more on these and all of today's top stories, go to nationalmortgageprofessional.com.